So they need to definitely increase the price to not only handle its variable costs, but also to handle its fixed costs. So let's look at this part. Cresan Company reports the following operating results for the month of June. To increase net income, management is considering reducing the selling price by 10%, with no changes to unit variable costs or fixed costs. Management is confident that this change will increase unit sales by 25%. Using the contribution margin technique, compute the break-even point in units and dollars and margin of safety in dollars, assuming no changes to sales price or cost, and assuming changes to sales price and volume as described above. So management thinks it will increase its net income if it cuts the sales price 10%, and it thinks its volume increase will go up 25%. So what we're going to first do is just see how this plays out with the information we have. So we assume no changes to the sales price or any costs. What is the break-even point in units? How are we going to figure out the break-even point in units? Can we take our $24 contribution margin, and if we take our 100,000 fixed cost, divide that by 24 bucks, won't that give us our break-even point in units? 100,000 divided by 24 gives us 4,167 units. In terms of dollars, we know we're selling each unit for 60 bucks, so we could take our 4,167 times 60 bucks, or we take our 100,000 of fixed expenses divided by our contribution margin percent ratio of 40%. Does that make sense? And then margin of safety in dollars. If we take our margin of safety in dollars, the 300,000 right now in sales minus our 250,000, which is our break even, then that means our margin of safety in income is 50,000. This is 300 what we're currently producing minus our break even sales is 250. Gives us our 50,000 margin of safety. Okay? Now we're going to change it. Now we're going to see, we're going to change up the figures. Now we are going to, assuming changes to sales price and changes to volume. So, if we change the sales price, we wanted to reduce the sales price 10%, right? So wouldn't that be 54 bucks is how much we would reduce the sales price, right? And so the 54 bucks means our new contribution margin is going to be $18, right? So in terms of break even, our $100,000 of fixed cost divided by $18 being the contribution margin means now we need to break even having 5,556 units. Okay? Before, it was 4,167. Okay? Then in sales, we've got, as far as dollars go, the 5,556 at 54 bucks a unit, right? So 5,556 times 54 unit gives us how much? I think I'm doing something wrong. Yeah, well, they're wanting break-even point in sales dollars. So if we keep in 300,000 in terms of sales dollars, and we then show our new sale price, 54 bucks a unit, it then tells us what our contribution margin is, 18 bucks. So basically, margin of safety in dollars, if we do sell 5,556 units at 54 bucks a unit, what does that give us, guys? 5556 times 54 bucks a unit. What?
Just over 300,000.
Okay, let me see what I'm thinking wrong here. Break-even point. 100,000 our fixed costs divided by our the ratio, the 18,000. So basically, we need to break even. To break even, we need to have 300,000 in sales to break even with our new unit price decreasing. Okay? So basically, if we then sell 337.5 minus our 300,000, our new 18 bucks a unit, what we now know is they think that we're going to be able to increase our sales by 25%, right? So 25% to increase our sales of 5,000 units means we now can sell 6,250 units by 54 bucks with our lower price, means our new sales would be 337,500, which gives us our margin of safety between the difference what the break even is and the new sales price. I kind of confused myself, so let's look at this again. Here, let me look at this, then we'll go through a problem. So basically, the break-even point and the decrease in the margin of safety indicate that management should not implement this proposed change. The increase in sales volume will result in contribution margins of 112.5, which is 7,500 less than the current amount. So basically, what they're trying to say here is they had an idea if they decrease the sales price by 10%, it's going to increase the volume by 25%. But when you compare the sales as it currently stands versus the proposed changes, it's not beneficial, because ultimately the contribution margin with the new idea is less than the way it currently stands. It's not going to profit them at all. So basically, what I'd like to do is just work on some problems, because sometimes that's the best way to explain this scenario. So let's go to the book and let's look at exercise. Let's do exercise 6.1. Okay? Exercise 6.1. The Soma Inn is trying to determine its break-even point. The inn has 75 rooms that are rented at 60 bucks a night. Operating costs are as follows. Determine the inn's break-even point in the number of rented rooms per month N in terms of dollars. Okay? So I'm going to use this slide because I've got it here. So we've got the break-even point in terms of number of rooms. The rental per room is how much? 60 bucks. What are the variable costs per room? $42. So what is our contribution margin? 60 minus 42 is 18. We also can determine the ratio. If we take our 18 divided by 60, what would be our contribution margin ratio? 30%. Perfect. Okay, so break even in terms of rooms, our fixed costs are how much? 15,300. Our contribution margin per room is 18. How many numbers of rooms do we need to rent? 15,300 divided by 18 is, I'm sorry, 850. Now let's figure it out in terms of dollars. Our contribution margin per room we said is 30%, right? Our rental per room is 60 bucks. Or 18 bucks, 60 bucks. The ratio is 30%. We need how many rooms? 850. Rental per room, 60. Gives us break even in dollars is how much? 850 rooms times 60 bucks a room. Hmm? 51,000. Another way we could do it is take our fixed costs of 15,300 divided by 30% gives us our break-even point of 51,000. Okay, now go back and it says if the inn plans on renting an average of 50 rooms per day, assuming a 30-day month, what is the monthly margin of safety in dollars and the margin of safety ratio? So now we know we want to rent 50 rooms a day times 30 days, which is 1,500 rooms, right? Whoops, sorry. Right? 1,500 rooms. So 1,500 rooms, break even sales. How much do we need to break even? I'm sorry, 1,500 rooms times 60 bucks a day is how much? I'm sorry, what? 1,500 rooms times 60 bucks a day? 90. The break even in sales right now is 51,000, right? So what would be our margin of safety? 39,000. Now let's determine it in ratios. Margin of safety in dollars, 39,000. If our sales are 90, what's our margin of safety ratio? 39 divided by 90 would be, we know it's over 30%, 43%. Okay? Make sense? How you guys doing? Okay, let's take 6.3. 6.3 says, Barnes Company reports the following operating results for the month of August. Sales of 325 with units of 5,000, variable cost of 210, fixed cost of 75. Management's considering the following independent courses of action to increase net income. Increase selling price by 10% with no change in variable or sales volume. Reduce variable cost to 58% of sales. Reduce fixed cost by $15,000. Compute the net income to be determined or earned under each alternative. Which course of action would produce the highest net income? So, what we need to do is figure out sales of 325,000 divided by the units of 5,000 units gives us how much in sales per unit? Someone said it. $65 in sales per unit. So, current selling price, 65. What would be the new selling price? 71.50, right? I'm just going to keep it at 71. Will it let me? Darn it. Let me do this. There. 71.50. So, what would now be our total sales? 71.50 times what? Times 5,000 would be net income of? Yep. Our variable cost. How much are our variable costs? Well, they're not going to change per unit, so we can just look and see if our variable costs are 210. We'll put in our variable costs. What's our contribution margin? The 357.5 minus our 210. I'm sorry, 147.5. What are our fixed costs? Fixed costs, say 75,000. So what would be our net income? $147.5 minus 75 equals 72.5. Okay? Do you see what we're doing here? We're looking at different scenarios. Now, the new one says reduce variable costs to 58% of sales. Okay? So, this, we're not changing the net income. Okay? So, if we go back here, our sales were 325,000. We're going to put that in. But now they say our variable cost should only be 58% of sales. So 58% of 325 is what? $188.5 gives us a contribution margin of $136.5. What are our fixed costs? 75,000. So our net income, 61.5. Now it wants us to reduce our fixed cost by 15,000. So we've got our sales still of 325. Our variable costs should be, if we go back to the original, 210, right? So our contribution margin is $115. Our fixed costs are going to be reduced by $15,000, which means they're $60. So our new net income is $55. Which one do you think is best? First one makes the most money, doesn't it? Right? Okay. Let's see. Let's do E65. Carey Company had sales in 2016. Is this helping, guys? Carey Company had sales in 2016 of $1,560,000 on 60,000 units. Variable costs totaled $900,000 and fixed costs totaled $500,000. A new raw material is available that will decrease the variable costs per unit by 20%, or by $3. However, to process the new raw material, fixed operating costs will increase by $100,000. Management feels that 1/2 of the decline in the variable cost per unit should be passed on to customers in the form of a sales price reduction. The marketing department expects that this sales price reduction will result in a 5% increase in the number of units sold. Prepare a projected CVP statement assuming that the changes have not been made and assuming that the changes are made. Okay? So, what we're going to do here is do it both ways. Let's start by creating a Carey Company Okay, so the first thing we're going to do is, what are sales? Has it at 60,000 units, and we've got 1,560,000, right? So 60,000 units, 1,560,000. And that is 60,000 units. So how much does that break down per unit? I'm sorry, 26 per unit. Okay? Our variable costs are $900,000. What does that equate per unit? 900,000 divided by 6,000 units is $15 a unit. So now our contribution margin should be $660 or $11 per unit, right? Now our fixed costs are $500,000, which means our net income is $160, right? Now, what we need to do is now go and calculate the changes. So, a new raw material is available that will decrease the variable cost per unit by $3. So, I'm just going to take this, copy, put it over here. So now now our variable cost will be decreased by $3 a unit. So our new variable cost will be $12, right? However, to process the new raw materials, fixed operating costs will increase by $100,000. Okay? So instead of $500,000, this is going to be $600,000. See what I'm doing here? Management feels 1/2 of the decline in the variable cost per unit should be passed on to the customers in the form of a sales price reduction. So that means our $3, $1.50 should be passed on, right? So a $1.50 reduction means the new price should be $24.50, right? Whoops. How come I can't? There, $24.50. Okay? So $24.50 should be the new sales price minus our variable costs. What will be our contribution margin now? $12.50. Okay? The marketing department expects that this sales price reduction will result in a 5% increase in the number of units sold. We did have 60,000 units sold. How many units are we going to have now sold? 63,000 units, right? So 63,000 units at $24.50 a unit. $1,543,000. Okay? The variable costs are going to be 63,000 times our new unit price, $756. So now our net income is going to be $187 because our fixed cost increased, right? Should we do this? We should do it? Good, guys. Okay. Let's look at E6. How's everyone doing? Yard Tools manufactures lawnmowers, weed trimmers, and chainsaws. Its sales mix and unit contribution margins are as follows. Yard Tools has fixed cost of $4,200,000. Compute the number of units of each product that Yard Tools must sell in order to break even under this product mix. Okay, so it tells us the sales mix. So the 100% of sales, 20% are for lawnmowers, 50% are for weed trimmers, 30% are for chainsaws. And it tells us the contribution margin. Okay? So what we're going to do here is to determine, I'm going to write these down real quick. So we've got lawnmowers, weed trimmers, chainsaws. We've got the sales mix percent. We've got unit contribution margin. And then we've got weighted average contribution margin. Okay, so our sales mix, 20%, this is 50%, and this is 30%. Our lawnmowers give us $30 a unit, $20 for weed trimmers, and $40 for chainsaws. Okay? So, if we look at this, our margin, we have 20% we sell in lawnmowers times our contribution margin of 30 gives us a $6 margin weighted out. Our weed trimmers, we're going to do the same thing with, give us $10, and our chainsaws give us $28. So all of it totals here whoops, I didn't want to do that. $28 is the weighted average contribution margin. Now, the total break-even unit in sales. So our total break-even sales in units has to be what? 20 unit weed trimmers. Yard Tools has fixed cost of $4,200,000. So our break even has to be the $4,200,000 divided by our $28 to give us what? How many units do we need to sell? 150,000 of this mix, this unit mix. Right? Now it says to us, compute the number of units of each product it needs to sell. So we basically have this new 150,000. So basically it's going to need to sell under the total break-even in units. If each is 150,000, then we've got to sell 30,000 units of the lawnmowers, 75,000 units of the weed trimmers, and 45,000 units of the chainsaws to give our 150,000. That make sense? Because we're looking at it as a grouping of products. We no longer just have one product, we have a mix of products here. Okay? How you guys doing?
why is it 150,000 of each one? Would it be 50% of your sales are coming from?
Well, the group, we need 150,000 units of this group. So if in the group, lawnmowers are 20% of the unit, the group, weed trimmers are 150,000 of it, chainsaws are 30, then that means we need to sell 30,000 of the lawnmowers. We need to sell 75,000 of the weed trimmers. That makes sense? Okay. Let's just do